Hey traders, let me ask you something. Have you ever opened a trade and instantly you are already in a loss? Now, you did not press the wrong button, you did your analysis correct. In fact, you waited for this trade for a whole day or two, but somehow your trade starts with a negative, even though it's going in your direction. That right there is not a mistake. It is something called spread. And today, I'm going to break it down for you in a way that is really simple and easy for you to understand. Welcome to Vida FX. Our goal here is to simplify trading for beginners as easy as possible. Now, spread is how brokers make money off you, and I'm going to explain how it affects your trade. So this is what we'll be learning. We're going to learn what spread is, how it works, how it secretly affects your profits, the types of spread we have, and why it matters. So what is spread? Let's keep this really simple. Like I said, spread is the difference between the buy price and the sell price of a currency pair. I'm sure if you're following this channel, currency pair is not something new or strange to your ears. But if you don't know what a currency pair is, do check out my previous video. We have a video on currency pair. Now, whenever you want to enter a trade, your broker gives you two prices. Now, when I was explaining our first video on Forex 101, I told you what a broker is. I told you that your broker is like the middleman between you and the financial market, because you're not going to go to the bank to tell them to give you Euro USD. You're going to use a broker. They are a brokerage firm. That is what you use to buy this instrument, right? So your broker gives you two prices. One is the bid price, and that is where the price you can sell at. And the second price is the ask price, which is the price that you can buy at. So the difference between these two prices is the spread. I'm going to really explain this. Let's imagine this. Let's use like our everyday life or whatever we experience to explain this. So let's imagine this. You walk into a phone store, you buy a phone for $500. Now, immediately you step outside and let's say you change your mind for whatever reason and you go back to that same store, or maybe you're trying to sell to somebody else. But let's just say you go back to the store and tell them you don't want to buy again. You want to resell it to them. And now the owner of the store is offering $480. And you're like, I just bought this phone. It's still in the pack. I've not done anything. I have not even used it. So what is the problem? You're confused. Now, you just bought it. So how are you already losing money? Now, that $20 difference is exactly what spread is in Forex trading. So your broker takes a fee for every time you open a position. So let's say Euro USD is showing the buy price at 1.1002 and the sell price is at 1.1000. Now the difference is 2 pips. Remember I talked about pips in our videos on pips and lot size. So if you don't know what a pip is, do well to watch that video. That means the spread is 2 pips. And I told you that the price of the pip depends on the lot size you open. So if you're opening with a smaller lot size, the amount you're paying to your broker will be smaller. If you're opening with a big lot size, the amount you're paying with your broker will be bigger. So immediately you enter the trade, you're already 2 pips in loss. And 2 pips could mean $20, 2 pips could be $50, 2 pips could be $100, depending on your position sizing. All right. So how exactly does spread work? Now, every time you open a trade, you enter at the ask price. And remember I said the ask price is the price you're buying at. But if you close that trade, let's say you open it immediately and you close it immediately, you're selling at the bid price. So even if you open that trade and it doesn't take 5 seconds, you're already losing money. So that difference between the ask price and the bid price is what creates the instant loss that you see. So how does this affect your profit? Now let's say your strategy is aiming for 10 pips, 10 pips profit, and your spread is 3 pips because you're trading at a time when the spread is really large. That means your actual profit is only 7 pips. Now imagine you take 10 trades in a day, you open 10 positions in a day. You're losing 30 pips daily just from spread, and that is huge. And let's say each of your pip, based on the lot size you're trading, each pip is, let's say, $5 or $2. Now times $2 or $5 times 30 pips daily. $2 times 30 pips is already $60 in loss for no reason. And there are times when the spread could be more, depending on what time or what pair you're trading. So what are the types of spread that we have? There are two main types of spread that you must know. One is fixed spread, and the second one is the variable spread. Now the fixed spread doesn't change, it stays constant. It's good for beginners and it's easier to predict. The floating spread changes constantly from time to time. It can be very low in a calm market, it can spike during news events. For example, like during major news events, spread can drop 2 pips, 10 pips, or even 20 pips, depending on the pair and the time you're trading those pairs. So why does spread matters? What is your business? Why is it something to be concerned about? Spread can make or break your trading. Now, if the spread is too high, your profit reduces. So even though your analysis is correct, everything you've done is correct, spread alone can reduce your profit margin, and your trades can take longer or go into profit. So you can actually be in profit but still in loss. I know that's a bit difficult to understand, but let's say you go to TradingView to do your analysis. You take your entry price at 1.10. Now the spread is 5 pips spread. Now your trade has actually activated, but until it counts 5 spread up, you're not in profit, even though you're already supposed to be in profit. So if your strategy target 10 pips and the spread is 3 pips, you're already losing 30% of your profit, and that is huge. That is huge. So I already explained why you start in loss. This is why beginners panic. They think, did I enter wrongly? Is the market against me? Is somebody somewhere pressing this button that whenever I enter a trade, they're going to... So sometimes you see that you not enter buy and sell at the same time. You'll be like, okay, if you don't want to come from buy, I'll be buying. If you don't want to come from sell, I'll be selling. And somehow, even though you're in a buy and in a sell position at the same time, you're still in a loss. And then you panic, and then you be like, what is going on? Oh my God, this is not working for me. No. You don't have to panic. So spread is like you're simply paying the cost of entering the market. That is how your brokers make money off of you, okay? That's how they get paid. So they are not charging you. They just take a percentage of money from every time you open a position. So this is a clear example of a spread. If you open your MT5, I covered a lot on our video about how to use the MT5 app, which you as a beginner trader needs to master. Now look at the green line that is showing the price of 1.19514. This is Australian dollar against the New Zealand dollar. Now look at the bid. The bid price is the one showing red, which is where you're selling from, okay? And it's at 1.19540. And then the ask price is the blue line on the chart, where the price is showing at 1.19514. Now notice that the difference in price is huge. The difference in these two prices, the first one is at 540, the second one is at 514. That is a whole difference of... So let's just say, if you want to know the difference, just say 40 minus 14, because we're working with the last numbers, right? So 40 minus 14 is 26. Yes. So the spread for this particular pair at this particular time is a staggering 26 pips spread. That is a lot. You want to avoid this kind of market, and it's not difficult for you to see. Okay, once you enter your MT5, you see where the bid price and the ask price is. Check the difference between the two, so you know if that pair is worth buying or selling at that particular time. Because for this pair, until that red lines, let's say you enter where the red line is, right now, until it comes down below, you're not in profit, even if you're supposed to already be in profit. So sometime during news events, we have a lot of news events. Maybe I'm going to do a video and cover like the different type of news events and how to know economic data. As a trader, you need to understand the different news events we have before you go into trades. Okay, now sometimes you can watch news on Bloomberg and all of this financial news TV to get updates on what is going on in the real world. Remember, I said that whatever we're trading real currencies, real countries currencies. Okay, so whatever it is you're doing, you should be updated. You should know what is going on. The president of the United States can just go to Twitter and tweet something, and you see the market reacting violently. So it is important for you to understand what news is. And maybe I'm going to do a video and cover how to check the different news events and where to check them from. So when that happens, the market is super volatile. Like in a second, you could see a move that could take a week to happen. It will happen in a second when it's time for that news. So if you enter a trade during news, suddenly your stop loss gets hit. Your trade closes instantly. Not because the market moved, but because the spread widened. So during that time, there could be slippage and price could eat into your profit. So this is also an example of how it looks like on your MT5. Now look at the quotes, look at the currency that we're trading. You notice the number below it. You see 15 on the Australian dollar against the Canadian dollar. You see the Australian dollar against the Swiss francs. You see 14. You see Australian dollar against Japanese yen. You see 12. You see Australian dollar against New Zealand dollar. You see 18. Those are the spread. Now when you check the bid and the ask price, you've seen the first currency showing at 0.96368, and the second one is showing at 0.96383. Now if you minus 83 from 68, which is the last numbers there, it will give you 15. If you minus 68 from 83 or 83 from 68 to give you 15, that's the spread. Same thing with the second pair. If you minus 48 from 34, it will give you 14. So that is the spread. So you want to avoid pairs that have too much spread, and also depends on the time of trading them. Now look at a normal spread. If you notice in this pair, this Euro USD, Euro against the US dollar, you can see that the bid price and the ask price are almost overlapping. Look at the sell price. It's selling at 1.15740. This is a live market, by the way. And look at the buy price. It's selling at 1.15740. So the buy price and the sell price are the same. There's no spread. It's zero spread. So at this time of the market is very, very volatile. Price is moving, there's money moving in the market, there is a lot of trading activities going on. That is why. So you can see that the prices are the same, there is no difference. So it's zero spread. So in this kind of market, once you enter a trade, it will start reacting. If you're in a sell now on this trade, it will already start showing you profit. Okay, so professional traders don't ignore spread. They choose low spread brokers. So you want to do a research on your broker, check out their spread, check out their margin level, check out leverage before you choose a broker. Trade at optimal times. Now you see that Euro USD, it depends on if you trade it at night, let's say at 1 a.m. and all of those times when the market, the London session and the New York session are not open, the spread will be wider. It will not stay zero. But if you trade at peak hours, let's say the opening of London session, when it overlaps with the opening of the New York session, you see that the spread is 0 or sometimes 1. It will just be fluctuating between 1 and 0. So avoid unnecessary entries. Like I said, professional traders, they avoid unnecessary entries because they understand that in trading, cost control is equal to profit growth. So here are some tips that you should start using immediately. Trade major pairs like Euro USD. You can see that the spread was 0. Great Britain pounds against the US dollar. Those are major pairs. Remember in our video on currency pairs, I covered in detail the types of pair that we have. We have major pairs, we have minor pairs, we have exotic pairs. You want to avoid trading those exotic pairs because the spread will kill you before you even start making money. Avoid trading during high impact news. Trade during London and New York sessions. Use low spread brokers. Avoid over trading. These small changes can save you a lot of money. Now, if you're serious about becoming profitable, understanding spread is not optional, it's mandatory, because this small number you ignore can silently drain your account. And spread may actually look small, but over time, it can destroy your profit silently. So now that you understand it, you're already ahead of most beginner traders. If you learned something in this video, please give this video a thumbs up, turn on the notification bell, and subscribe for more tips. Drop in the comment if you want me to do any video specifically. Thank you guys so much for watching. I'll see you in the next. Peace out.